Hello and welcome to another episode of Fractional Impact. Today we're speaking to Rob Church, who is a CPG operations expert, about how he approaches cost savings without hurting quality, what founders often miss when building co-manufacturer partnerships, and how to free up cash, improve in-stock rates, and reduce daily operational stress. Rob, would you like to introduce yourself?
Yeah, thanks, Stuart. Thanks, Gianna. Happy to be here. Excited to have a conversation with you. I'm Rob Church. I'm a fractional COO operating in the CPG space, specifically with food, beverage, and supplement brands. And I've been in the CPG industry for about a decade and have just enjoyed working with founders and growing their businesses.
Awesome. And we're joined today by Gianna Maliari from the Fractional Clients team. If you'd like to introduce yourself, Gianna.
Thanks, Stuart. Yeah, I work at Fractional Clients and I help with all things sales and client delivery. And I'm super excited to be getting into this with Rob today.
Awesome. So my first question for you, Rob, just so that the listeners and viewers can get a deeper sense of who you are and what you've actually done, talk a bit about your experience and what you've been doing over the last few years.
Yeah, so as I mentioned, I've been in the CPG space for about a decade. I started off my career with Suja Juice, a cold pressed juice company based out of San Diego, California, where I reside. And I got involved with Suja when they were a small growing company. I came in at about 40 million in revenue in 2014. And I got it started in the operations department. I didn't really expect to be in operations. My degree was in finance and entrepreneurship. But my uncle, who was a co-founder and CEO of that company, offered me a job because I had interest in working in a startup. So over the course of 7 years, that company experienced just tremendous growth. It was a lightning in a bottle kind of situation. And I got to be part of the growth story from 40 million in revenue up to about 200 million in revenue. And through the course of my time there, I became director of supply chain and responsible for all the procurement, all of the warehousing, and all of the distribution. So all the traditional supply chain functions. From there, I had the desire to go out on my own and started a company called Edge Theory Labs with my cousin Joshua, which was a athletic recovery product in hardware product in the athletic recovery space. And it was a iceless ice bath. So think cold immersion and how athletes get into cold tubs for athletic recovery. We made a portable concept of that. That business we ran for 3 years. We ended up doing about 20 million in revenue, of lifetime revenue, and fundraised $1.3 million. So not only do I have the CPG traditional experience with running supply chains, but I also am a founder myself. We got out of that business in 2024, and I'm now a fractional CPG operations executive, helping businesses grow in anywhere from the $2 to $20 million revenue range.
Yeah, that's awesome. I think the people that have sort of gone fractional effectively and they're doing fractional work, they seem to do so much better and deliver so much better results for their clients when they've actually been a founder themselves. Because I think founders really appreciate that, because if you bring in someone that's C-suite and they've not been in the founder's shoes, then there's certain things they just can't relate to, What were the most important decisions that you were involved in that allowed Suja to go from 40 million to 200 million?
There were a few things that helped Suja really excel in that space. It became very competitive during the time I was there. When we started off, there were 4 or 5 competing brands in the ultra premium juice space. And by the time I left, I think they were closer to 70 competing brands. So it did get to be very competitive. And I think what helped Suja break through was vertically integrating their operations and supply chain early on. So they very quickly brought in their own organic sourcing. They had an organic broker that was procuring all their organic raw materials, which in 2014 wasn't anywhere near as common as it is today. And then they also vertically integrated their high pressure processing machines, which is what keeps the juice safe for consumption and extends the shelf life. And they vertically integrated and brought in those HPP machines in-house very, very early on. And that really helps them be able to own their destiny and control their scale. They were also really quick to innovate. We introduced over 250 new SKUs while I was there. SKUs being individual unique items. Not all of those were unique recipes, but many were. And what that allowed Suja to do is to really quickly test the market and see what resonated with consumers. And we were able to quickly work with our retail partners on introducing new SKUs and getting bad ones out. And that helped us really find a lot of real big winners at key retailers.
When you're working with a company that's growing at such a rate, and I guess when you're working in operations, you're overseeing everything in quite a holistic manner. How are you identifying opportunities like that to unlock such growth?
Typically, I want to look at where the biggest challenges are, what feels the heaviest for a founder, what feels the stickiest, because those are usually the areas where there's a broken process or lack of a system. And what I like to do is I work with founders or with a organization is try to figure out how to make everything fit into a system. The system being built up of unique individual processes. And so an individual process might be something like entering in sales orders into a spreadsheet if they're working off of spreadsheets, or individually cutting unique POs. Now, if those are all happening independently, what can happen sometimes is those processes will break if they're not being constantly managed and improved on. And so all of these processes should build up into a self-reinforcing loop. And that then becomes a system that can be a little bit more autonomous and help flag when things are not working properly.
You mentioned there that with Suja, one of the things that helped take them from 40 to 200 million was creating vertical integration, as you said. Is that something that you commonly recommend to companies and basically always works well? Or is it something that you only recommend implementing under certain conditions?
Yeah, it's a great question. It really depends on the scale and the stage of the company. For a company that's in the $2 to $20 million stage, they're probably too early to start implementing that level of vertical integration. But it should be something that's thought about and planned for if you're experiencing double-digit year-over-year growth, because at some point you're paying a margin to somebody else to manufacture your product or to do those services. And so, for in the Suja example, if you're paying double-digit margins to procure your organic materials, that's just straight costs going out the door. And same for the HPP tolling, the processing of the juice. And so bringing that in really helps unlock key savings that makes you much more competitive. But a young brand oftentimes can't do that. And in reality, oftentimes the co-manufacturer, if you are working with a co-manufacturer, can get you a better cost structure because they're able to buy volume with their other customers if you're able to utilize their portfolio of ingredients or services.
Yeah. And if you're working with a company and you decide, okay, we should vertically integrate, there must be a delay in actually seeing the results from that. Like I would assume if the time is now to vertically integrate, then you're a bit late and you probably should have planned it in advance. When should you be starting to think about vertical integration, or at least plant the seeds for it, so to speak, for when the time is right?
I think that it's part of a good operational roadmap right from the very start. I don't think that you necessarily know, you can't necessarily connect all the dots at any given point in time. And it's easier certainly to look back and say, we should have done X, Y, or Z then. But early on in the operational plan, it should be known that, okay, once we get to about 5 million revenue, we should be here. Once we get to 20 million revenue, we should be here. Once we get to 50 million, we should be here. And having those milestones along the way helps you, once you get to that revenue target, kind of have an understanding of at what point these things will start to make sense. And a good way to do that is to start really understanding your cost structure. A lot of founders that I talk to are so busy, wrapped up in the business, trying to grow it, and just keep the wheels on the bus, that they don't look deeply enough into the drivers of their COGS and the overall P&L of their product. But if you really can get into the depths of what is driving your cost structure and what's going into the P&L, then you can really clearly see, okay, at $10 million in revenue, if I'm paying 10% on my highest, my 10% or 20% to my co-manufacturer or for X, Y, or Z service, then you can quantify that and you can know at what point making the capital investment to bring it in-house or vertically integrate makes sense.
Yeah, interesting. And you were kind of saying there that maybe a lot of founders don't bring in someone for operational leadership, maybe until it's a bit too late, or until something breaks or something like that. What is usually the first breaking point in operations that founders stumble into?
Typically, what I see with founder-led operations, what seems to break first is demand planning and forecasting, inventory management, in essence. Usually what happens is a founder is able to have a really good understanding and a good gut intuition of what when to reorder things and how much to produce. But as the company grows and scales and things become more complicated, new SKUs come in, new retailers come in, those things start to become a little disintermediated and more difficult to have that gut intuition about. So typically what I'll see is somebody will call me when there's an out of stock situation and a retailer is getting frustrated by consistent or recurring out of stocks on important items. Or they are maybe a self-manufacturer, or maybe they're providing raw materials to their co-manufacturer and they're having issues with getting the right raw materials at the right time for their co-manufacturer. And that's usually because, again, the growth has gotten out of the range where the founder is able to really confidently predict it with gut intuition or with basic spreadsheets. So I typically like to come in and support them with demand planning, inventory management, and forecasting as some of those tools to help solve that problem.
When you're coming in to help out a company or a founder, are those the things that you're looking at first, or is that part of other things that you'll be identifying?
It depends on the company. If I'm coming in for general operations support and there isn't necessarily a clear cut, this is what I want you to work on first, what I'll typically do is look at the major cost centers. So I'll look at manufacturing, I'll look at raw materials, I'll look at distribution costs, and I'll look at inventory carrying costs. And from those, I typically like to look at what feels the most challenging, the heaviest, the stickiest, the problems in the founder's eyes, and then or the least managed, most complicated process. And then I start to look and focus on that area of opportunity first, because that's usually what's been neglected. And as we all know, what's been neglected isn't being managed. So I would typically look at those areas first and seek out the opportunity there.
And you were saying there about how inventory management is sort of one of the biggest pain points, especially for maybe growing companies in CPG. What does it actually look like to have healthy inventory management for a growing CPG brand?
I like to see a brand that's in this $2 to $20 million kind of range. I like to see them have a healthy demand planning model, and so that can be something as simple as just a spreadsheet that is going out on a 12-month rolling basis. But I like to see them have a forward-looking forecast that's built in the demand plan, historical look back of what demand actually was. Like to see a safety stock be set and agreed upon with leadership, meaning the amount of inventory that we just won't go below. Consistent lead times from the co-manufacturer or internal manufacturing. And then also importantly, alignment from the leadership team of how much cash are we comfortable paying out for carrying inventory. Because that can be a big factor that is often overlooked in the terms of the business. Oftentimes, businesses don't really factor in how much cash is tied up on the balance sheet for a solid safety stock of inventory, and that can lead to out of stocks.
Yeah, and on the topic of co-manufacturers, how do you evaluate them for a small company and decide if they're going to be a good fit long term? Because I would assume choosing the wrong co-manufacturer could be fatal for a small company.
Yeah, it's arguably the most important partner that you're going to have in the business. Your co-manufacturer is bringing your product to life and is responsible for a lot of your success or potential catastrophe if not done properly. So it's a really important relationship to have, and vetting them out is tough. There's not always a clear-cut manufacturer with the exact capability set that you need. And if there is, oftentimes you're not really able to test the relationship out and see how things are going to work. So a few of the things that I like to take a look at with co-manufacturers to understand if they are going to be a good partner is kind of just looking at a few, more or less subjective qualities, but adding up to kind of a picture in totality. Some of the things I look at that are red flags is if they're disorganized, if they're not very responsive. So like you reach out and they don't get back to you quickly with an answer. You feel like they're nickel and diming you from the start. Obviously, if they don't have the technical expertise, they don't have the actual capability in-house to do it, that's going to be a disqualifier. But if they're not willing to gain that technical capability, whether it's a piece of equipment or a technical process, that's obviously going to be an issue as well. And then I like to see that they are willing to go beyond just those basics and be a true partner with the brand, meaning they're willing to bend the rules. So if they have a standard way of doing things, but your company every company wants to be differentiated and have a unique selling point. Oftentimes that comes from manufacturing the product itself. So if they're willing to bend the rules and be a good partner in that way, that's a good sign.
Yeah, definitely. One of your specialties, I guess, is unlocking cost savings for CPG companies. How do you go about that? How do you do that without, breaking parts of the process or damaging quality in one way or another?
Yeah, the cost savings optimization is one of my favorite things working with businesses. It's an opportunity to make a big impact in the bottom line of the company, and frankly, pay for the retainer and the work that I'm doing for them as well. It's really kind of an earn back in a way that benefits both parties. It's kind of a win-win situation. And what I try to do with coming into a company with finding cost savings opportunities is first working with the current partners and the current vendors, the current relationships that are in place, because that's what's gotten the company to this point. Sometimes those can be strained, but I found that just coming in with a fresh perspective on a lot of the operational components and stating that I'm wanting to work with you as a partner to improve X, Y, or Z cost structure or service level can go a long way. But there also needs to be some leverage and understanding of what the alternatives look like. And so while working with the existing partnership, I also like to conduct a request for proposal or request for quotation on the product or services that are being offered, and talk to a few different other companies. It depends on the nature of what we're looking at from a cost optimization perspective. But for raw materials, for example, I'll usually take the top 80% of spend, and that's usually just 20% of the raw materials. So the 80-20 rule typically applies there. And I'll usually talk to between 3 and 5 other partners for each of those raw materials and get a quote from each of them for the same volume, the same specifications, as closely as possible anyway, and see what they're quoting out. And then I compare that to the current partner. And if there's a big difference in quality, for example, or for cost, have a conversation with the existing partner about why that gap exists and renegotiate in good faith with that existing partner, but also not being afraid to move the business if the existing partner isn't willing to continue to work to optimize the cost structure or service for the business.
Yeah, interesting. Here's a slightly more challenging question for you, actually, on that note. If I'm a founder listening to this, maybe I'm thinking, that sounds great, but why don't I just get a junior person to do that? Like, why don't I just get my most junior, lowest paid person to save costs to call up alternative manufacturers and find the cheapest one that will give us the most savings? Like, what's the difference between doing that versus bringing in someone like yourself to go about that process?
So I think the difference there would be the level of experience that a junior person would have versus the level of experience that an operator with like myself with over a decade of experience in the CPG industry would have. Um, I already have a base understanding of where costs should lie and how things should work and the service levels that you should be expecting. So just the inherent experience that I've gained over the course of a decade doing this, and also having been the founder myself, I'm able to understand the business practicalities that go into these decisions. And also, there's a art of negotiation with these things. Not only do you have to negotiate with the vendor or partner, but there's also an internal negotiation that has to go on with the stakeholders within the business itself. A junior person can come in and maybe be able to find the 3 to 5 quotes for different raw materials, but if your head of innovation isn't willing to try out those alternative ingredients, you're not going to get anywhere with it, even if it is a major improvement for the product or cost or company.
Yeah.
Another sort of difficult question, perhaps, but do you think there are ever any situations where sacrificing quality for cost is suitable?
Absolutely, it depends on the brand. Every brand is going to have their own guardrails in place, and sometimes those guardrails are more fixed than others. It depends on the products. With Suja Juice, for example, we had pretty high guardrails in place for product quality, and that was a constant conversation that we were having with the innovation and R&D team around whether or not a certain ingredient is good enough or not. Part of the job of the operations department and the procurement team is being able to go back to partners, to vendors that may have a better tasting product or a superior spec on the product, and working with them to bring the cost down closer to where the more competitive but maybe lower quality product is, and finding ways to optimize creatively versus just straight on costs. And that can come down to things like payment terms. That can come down to how much inventory they're willing to carry for you, under contract, and things of that nature to really close the gap on improving the overall outcome for the business in all facets, not just from a cost perspective.
And with choosing the co-manufacturer or maybe switching from different vendors or things like that, because as you were saying, that is maybe like the most important decision for a small CPG company. You're the expert, but I would assume that getting some of the quantitative data from those suppliers or co-manufacturers might be quite easy, because they can send you the numbers on an email. How important is the more qualitative data side of assessing co-manufacturers, and what are the things to look out for there?
Yeah, that's a great point you're making. The co-manufacturer can look great on paper. They can have a beautiful website. They can say everything right in their email or their phone calls with you. But the devil is really in the details, and seeing how their operation is actually run. I like to always get on floor and see how the manufacturer is actually running in practice, and seeing if what I'm being told, on one end is the same as what I'm seeing in real life on the other end. And oftentimes that can be dramatically different. You can see great, beautiful pictures on a website from when the line was first installed 10 years ago, and you go in there and today there's water everywhere. There's puddles on the floor. The equipment is strung together with duct tape and zip ties. And you if you had just gone off without ever seeing the plant in person, you may have signed a supply agreement and been kind of gotten a bait and switch. And also, I like to have a third party inspection done. So in the case of the service I do for founders is I am that third party. The founder oftentimes is working with a co-manufacturer and they're assessing a new one. I come in and help assess if that co-manufacturer is a good partner, if they will do what they say, if they have the technical capabilities, if their certifications are in line, if their inspections are in line, how recently all those inspections and certifications have been done, and I can act as that third party arbiter as well.
Yeah, and I guess there as well, if a founder is assessing a vendor or supplier or co-manufacturer and they think it's the right call, and you come in, you do your third party inspection and agree that it's the right choice, then you've not actually changed anything, but the founder is going to sleep easier at night having faith in their decision. How much of your job is just doing that, like reassuring the founder, making sure people are confident in what they're doing because you've assessed it and you've approved it?
It's a decent portion of the job. I would say that I always like to add something of value, beyond just a rubber stamp. I really want to be able to come in and if that is the right partner for them, also provide some sort of value based on my experience of what industry standard is or what I think that the co-manufacturer would be willing to sweeten the deal with. So if the co-manufacturer comes to us and is it seems like a great fit and seems like they're the right partner to go with, okay, what's the kicker for getting us to switch our business? Because it's a risk. Even if there's cost savings in place, there's a risk. And so oftentimes I'll ask for something to sweeten the deal, like moving to move the business over, like having the new co-manufacturer develop tooling and amortize the cost of that over a multi-year partnership. Or maybe it's improved payment terms. But something to really have the co-manufacturer or new partner show good faith that they are excited and wanting to work with this business long term and are willing to do a little bit something extra to earn that business.
Yeah, makes sense. And you obviously co-founded Edge Theory Labs and got it to 20 million in sales, which is really cool. What did you learn about bringing a hardware product to life from scratch for the first time?
I learned it's really hard. My background in the CPG industry is a little different than the hardware industry. It was a direct to consumer product. We were selling on our website exclusively, but it was going through UPS and FedEx, and therefore there was a lot of synergies with the supply chain. But what I learned in Edge Theory Labs is that the hardware product, unlike CPG, the hardware product's got to last for a long time. The consumers expects it to be working for many years. And a lot of the times with a new hardware product, the gremlins in the machine don't come out for a long time. And so with the case of Edge Theory Labs, we were working with a co-manufacturer in China. And another learning opportunity was that Chinese relationships with factories work very differently than they do in the US. There's just a lot less legal recourse and a lot less ability to have the Chinese factory support you if something goes wrong. And unfortunately, that is kind of what happened with Edge Theory Labs. Is we had a factory that wasn't being a good partner, and we did have some gremlins in the machine that ultimately led us to a place where we weren't happy with the operation.
Do you think choosing suppliers and co-manufacturers in China versus a place like the US or somewhere in Europe is a bit more risky for those reasons?
I think it can be. Yeah, I definitely think it can be. There's a huge geographic, obviously, delta between where you are and where they are. And that makes it difficult to just go pop in and see how your product is being run. Even if you have a third-party auditor over there, which we did at Edge Theory Labs, have a third-party auditor, inspector looking at the product, it's just really difficult with the geographical distance. That's not to say that it can't be done. Obviously, the international supply chain is huge and can be managed really well, but there's another layer of a challenge that exists with that. And what we learned at Edge Theory Labs of how to kind of work and manage that Again, we had a third-party inspector that looked at every production batch. We got production records from major key performance indicators across the board from these manufacturers. We had an inspection period for when it got to the U.S. And then we also made sure that we had an ample amount of safety stock in case the manufacturer was delayed. And so we kind of did all of these things to smooth out those rough edges with the international supply chain. But it is a challenging way to do business.
Yeah, and with Edge Theory Labs, you'll be familiar with the common startup founder model, where one person is the sort of sales, the marketing, the dreamer type, and then the other is the more back end product, technical, not so visionary one. Was that kind of the relationship that you and the co-founder had for that company?
Yeah, my co-founder Joshua was very much that forward, outward-facing sales, marketing, business development personality. He had the vision for the cold immersion products from the start, and I was much more of the day-to-day, back of house, finance, operations, human resources, that kind of person that was kind of making it all work on the back end. And I think that dynamic works really well for founders at the beginning. It's incredibly difficult to start up a new business, just any business. And so having the ability to have somebody that is deeply invested, as invested as you are, helping with an area that you are not as expert in, just increases your odds so many percentage points, or so many multiples. I was very fortunate to have a co-founder, Joshua, that was helping me with that sales and marketing and business development side of the business that I just wasn't as good on, frankly.
Yeah. And so when you step into a company fractionally and they're maybe 2 to 20 million or that kind of range, is that usually the founder model that's there and you're working very closely with the more technical product person? Or are you usually going into a company because that person isn't there and it's just the sales BD type founder?
Yeah, oftentimes I'm going into a company because that person isn't there, or that person isn't categorically isn't contemporarily trained in operations. So they might have an operations person in place, but that person might not have extensive CPG experience or extensive supply chain experience. And that's kind of where things start to break, is if you don't understand where, again, the roadmap of where you need to be at certain milestones in the business, and you haven't planned for the growth, that's where things can start to go and become problematic. So I've come in both different circumstances. One where a founder was leading operations and just got out of hand because it was just too much work, and also where a co-founder was working in the business, but it started to get out of their technical expertise, and they have moved over to other areas of the business that is more aligned with what their traditional focus is. Sometimes that's a finance person ends up with operations because they are, operations spends the money in a lot of the money. So maybe that person goes back to finance, or maybe that person actually wants to get into more of the marketing side, or maybe that person wants to get out. There's different circumstances with each business.
Yeah. What's the ideal type of company that you are working with or are looking to work with at the moment? Like, what kind of revenue roughly should they be at? What challenges should they be facing for you to be able to come in and deliver maximum value?
Yeah, I like to work with brands that are in that $2 to $20 million range. I do work with brands that are pre-revenue as well, but it can be a little bit more challenging because there just isn't necessarily always the budget to get started. If you're pre-revenue, if you don't have any fundraising in place. So I typically try to work with brands that have seen product market fit. They've got some growth in place, and they're starting to see some product market fit within the market. And like within the food, beverage, supplement space, I have experience in all of these areas, and also typically working with a co-manufacturer. Those types of businesses are usually the ones that are sole founder led as well. And the operations have just gone a little bit out of hand for them.
Yeah. And I know that with the company you co-founded, you were able to get 7 figures in funding, which is really cool. With that experience, even though you're an operations first guy, are you able to help the companies you work with get more funding as well?
Absolutely. I think that my experience with not only the experience I have with operations and supply chain, but also experience with fundraising, I know what investors are looking to see from companies. I know what they're looking to see from the operational lens, but also from the overall organizational lens in terms of roadmap, what your projection should look like, how your deck should look. And so I do help brands kind of position the business for fundraising or for even a sale as well, since that is the ultimate goal for a lot of companies.
Yeah. How sort of desperate, I guess, are CPG companies in that 2 to 20 million revenue space? How desperate are they for funding? Because I know that with tech companies, those, sub 30 million software companies, a lot of the time, especially if we work with people, maybe CFOs, and we're doing any sort of outreach that suggests they could help with fundraising, it's like sharks to a seal or something. Like they're so desperate for funding, it's crazy. Do you see that in CPG as well, or not so much?
Yeah, there's definitely a demand for funds in CPG. They're hard businesses to get started and run. The reality is that the retailers, the grocery stores, or whatever retailers you're selling into, they command a lot of power over the brands, and they can dictate some pretty aggressive terms. Oftentimes, you have to pay to be on shelf. You have to pay a certain amount of money every year to support the product through advertising in their stores. The businesses are tough to get traction and product market fit with. So there is a pretty aggressive need for fundraising within these businesses. They can be cash flow positive if you have a really differentiated product and unique route to market. But typically, the life cycle of a CPG company, you're going to see a concept product that's been bootstrapped by the founder, gotten to a certain stage of product market fit, and then raise $1 million, $2 million for that initial push into retail. And then there's probably going to be a subsequent 2 or 3 fundraising rounds to actually get it to a scale where it is cash flow positive and able to fund its own future. It's a challenging business, and having operational support like the kind that I offer can really help that companies get the edge, because every dollar counts. They call it a penny profit business. And so every cent counts here in terms of what you can do to optimize your costs and your supply chain.
Yeah. And probably a lot of the companies you work with, the founder is buried in the operations right now and they want to get out of that. What's the first thing or the first place that you help them actually get clarity?
It depends on what they feel is stickiest. If they feel that demand planning or inventory management is the biggest challenge or the stickiest problem, I'll approach that. If they feel like they're bleeding cash and they need to optimize their costs, I'll focus on improving cost structure. If they feel like their co-manufacturer is never doing anything they say or doing it all wrong, then I'll focus on that area of opportunity. So it is kind of founder led in that way initially. And then once I kind of get more ingrained in the business with these longer term recurring relationships that I tend to have with my clients, then I'll start digging into areas that may not be as forefront or top of mind. Things like getting credits back for small parcel shipments. For example, if UPS is late on a shipment or misses or loses a shipment, oftentimes brands aren't recouping those costs, which can be significant. That also exists within Amazon and TikTok as well. Amazon loses inventory in their warehouses all the time. And unless you press the button to get a refund back, you're literally leaving money on the table. So after getting through the first, phase of challenges, then I'll start digging into those, more hidden problems or hidden cost centers that are within the business.
Yeah. And there's a lot of sort of financial or a lot of tangible benefits to maybe working with yourself, where a founder can see after 3 or 6 or 12 months, okay, Rob has saved us this amount or made us this amount. Are there any non-tangible, more subjective benefits of bringing yourself into a company?
Definitely. I like to be an advisor, as a fractional, leader on the team. I like to be working with founders in that capacity as if I were their COO, full time and part of the team. I get my hands dirty and help the business across the board with day-to-day decisions. If that's what the client and founder is asking for. So if they're looking at a new marketing initiative, or they're looking at a new go-to-market strategy, a new product line, I like to lend support and be of service with not only what the operational impact of that is, but also what's the business impact. How is this going to further the business's objective over the next 1, 3, 5 years, and be a resource and an advisor in that capacity.
Yeah. Gianna, any questions to close off?
No, it's been great, Rob. If anyone's listening and they want to reach out, what's the best way to find you?
Best way to reach out is at my email address, rdc@tripeakcpg.com, or visiting tripeakcpg.com and dropping me a note. I am excited to talk with any founders that are interested in expanding and growing their business and need operational support. And Stuart, Gianna, thank you for the time.
Of course, you're welcome. Well, thanks so much for joining us, and for the audience, thanks a lot for tuning in, and we will see you in the next one.